everybody to this webinar of Scientific Infra and Private Assets. My name is Abhishek Gupta, and I'm very excited to talk to you about this topic today, alpha in private market funds. I mean, we know that in private market funds, due to their structure that they are limited to only a handful of investments, there's often a topic of discussion that whether we are generating alpha, whether we are investing in private markets to capture that alpha. So the question comes in, how do you even measure alpha in the first place in private markets? And what does it mean or imply about market risk? Because alpha is on top of the return that you can make in the market. And these type of questions, they are serious questions that have been addressed in listed markets for a long time. And in this webinar, we are addressing some of those questions as well. And we'll show you some results towards the end. What does it mean to capture alpha and how we can use for not just as an exercise to assess funds, but also to rank and select managers eventually. Before we get going, just a quick background of our organization. Scientific Infra and Private Assets was born from the research developed at edX Business School. We are an index and data provider in operation since 2019. We have a global team of about 40 plus employees with one main agenda. We are trying to create some good quality data that can allow risk and performance measurement in private markets, which is not often the easiest subject to deal with. Our clientele includes many large sophisticated investors around the world, asset owners, managers alike. In total, they represent 33 trillion in AUM. Private equity AUM is about $1 trillion represented by these clients, and infrastructure is about 700 billion. So a good sum of investment is invested by these clients who rely on these solutions for their investment needs. And in terms of our products, very quickly, we have got two solutions. privateMetrics includes comparables and indices data. On comparable side, we produce data on valuation ratios, financial metrics like revenue growth, net income to sales, and so on. And this data is available for more than 1,000 segments, updated on a monthly basis. And we also have the ability, because it's backed by more than 1 million companies, that our clients can actually build comps based on their financial and qualitative characteristics corresponding to a deal or investment that they are after. On the market indices and benchmark side, we have a few flagship indices like Private 2000 and some geography-based indices. But then we also have more than 1,000 segment-based indices, which can be used to assess this asset class in a very granular and robust manner. On the infrastructure side, similarly, we have two solutions, comparables and indices. On the comparables product, we provide data like cost of capital, risk premium, valuation ratios for infrastructure debt. We provide yields, duration, credit spreads, and things like that. And again, this data is available for many segments, but can also be customized if you're interested in any particular type of project or asset in your exercise. For indices and benchmarks, we have Infra 300 series, which is widely popular now and has become the most representative benchmark for infrastructure. But we also produce Infra 100 series, Infra Green indices, and many hundreds of indices that can be split by different segments of the market. Right. So with that background, what's the agenda for today? First, I want to talk about peer group benchmarking. We know that it is the most common method to assess funds right now, but I wanted to highlight a few very serious issues in this approach and why it puts the whole exercise into question whether you can even rely on peer group benchmarking in the first place when you're assessing private market funds. Second, if not peer group benchmarking, then we wanted to show how you can compare a fund's performance against a market index. But the question becomes of the benchmark. Which benchmark do you use and what implications could it have on the final assessment? Third, I will show you some sources of alpha, that if a fund actually generates alpha, what are the different sources where that alpha comes from? And finally, using that analysis, we have produced some ranking of infrastructure funds and managers, and I wanted to show you some initial results of how those rankings look for different infrastructure funds and managers in infrastructure space. Right. So motivation, why did we do this study in the first place, right? Most academics and practitioners, they're used to using fund manager benchmarks that are the peer group benchmarks, which aggregate reported fund performance from many different sources. The problem is that by doing so, they sort of combine these different different sources of risk and performance, which are then very difficult to tell apart. One, the market performance of the whole private equities as a one unit. So that's the market as a whole that's get blended in these performance benchmarks. Second, the ability of the manager to select some segments, some styles for investment. That's what we call asset allocation alpha. And that's also blended in these performance benchmarks. And most importantly, each fund or manager, they have a strategy to select investments, and they follow a timing of cash flows as well. And that's also gets blended. We call this pure alpha, and that's also blended across managers into these benchmarks. And if you are unable to split these components, it's impossible to evaluate that which manager is performing well, how, and what are the performances of different funds when compared to against each other, because you can't really isolate the risk hidden behind that performance. And that's what makes it difficult to select the managers, or for managers to really set themselves apart from rest of the managers out there. And that's the reason why we are developing this study, and we are actually publishing a paper on this topic in a lot more detail. So the first topic, peer group benchmarking, and is it even possible to do? To conduct this exercise, we looked at some real data for private equity as well as for infrastructure funds. On the buyout side, we took the data from Preqin database. We have about 228 funds in the sample. And it's split out by vintage years, as you can see here, from 2011 to 2018. Vintages fairly even split. And the reason we chose these vintages is because, as you know, in the initial few years, most funds are still in J curve, and majority of the alpha is generated towards the later part of the fund's life. So we wanted to take funds which are now fully invested and have the capacity to generate alpha as they have become a bit more mature and now they're invested. So that's why we restricted this section of the analysis only to these fully invested funds until vintage 2018. AUM wise, they represent $400 billion in AUM, these funds that go in this study. By the geographic focus of these funds, they are more dominant in North America, as we can see, but also present in other parts of the world. And by the sector focus, 60% of the funds said that they are diversified in strategy, and rest 40% have a specific sector focus that go in this study. So we are taking them on their face value right now. If they're diversified, we are considering them as diversified strategy funds. Similarly, on infrastructure side, we have vintages 2011 to 2018 for the same reason, that they are fully invested funds, fairly represented by vintage years, a sample of 143 funds, and AUM-wise, $250 billion in AUM between these funds that go in the study. Geographic focus, more dominant in Americas region, about 60% in focused towards Americas, and by sector focus, 42% here are diversified, and rest about 57, 58% are more sector-focused funds on the infrastructure sample. Right. For these funds, we wanted to assess how peer group performance benchmarking would work. So let's look at buyout funds first. The left distribution is of IRR among all these buyout funds that are in our sample. And we see an average IRR, mean IRR of 17.5%, and median IRR of 18.5%, and interquartile range, the spread between first quartile and third quartile boundary, it's about 2,100 basis points. So it's a very wide range. And basically, the exercise is when you are trying to assess a fund, you try to place it in this distribution and assess the quartile rank. The problem is the IRR can be quite diverse, and we can see here as well the range is very wide. But if you look at TVPI, it's a more narrow distribution in comparison. Average TVPI is 1.66, median is 1.5, interquartile range of 0.8x. So again, the spread between first and third boundaries. But TVPI doesn't take account into timing of the cash flows and so on, which managers tend to believe is an important source of alpha in their performance. So pros and cons of both approaches, but more importantly, I wanted to take some findings from these two distributions. We see that 82% of the buyout funds have a positive net IRR. 75% of these funds have a net IRR above 8%. That is typically the hurdle rate used in buyouts. 82% of buyout funds have a TVPI above 1x, and close to 48%, 47% of funds have a TVPI about 1.5x. And that's net TVPI, right? After fees. So by looking at these numbers, we can say that, all seems very well, and everybody is enjoying these high returns in private equity. But the problem is, using this, it's difficult to tell that who is performing because they are really good at generating alpha or delivering that performance by picking good investments or by timing of the cash flows or purely by luck. It could be anything. Or they are generating that performance because they are taking a lot more market risk. And that's the part that gets hidden behind these numbers. Same exercise we can do with infrastructure funds. Left distribution is again of IRR and right of TVPI. On average, lower returns, 8.7% mean return, mean IRR in infrastructure funds. Median is 6.5%. Mean and median TVPIs are about 1.2x net of fees for these funds in the sample. And similar observations again for infrastructure. A majority of the funds have a positive net IRR, about 74%. 47% of the funds have net IRR above 8%, 51 above 6%. And these are the two popular hurdle rates used in infrastructure funds. Close to 75% of the funds have generated value, so their TVPI is above 1x, and about 50% of funds have TVPI about 1.2x. So again, infrastructure investors are receiving positive returns, but the question remains, is that return due to actually picking good deals or good investments, or is it a component that they're taking a lot more market risk to deliver those returns? And these questions make it difficult to perform peer group benchmarking in the first place. It makes it difficult to assess funds on an objective manner. Now, in a more practical example, this equation or this exercise of peer group benchmarking is really an equation between robustness and granularity. And I want to demonstrate it with the help of a real example. So here, I've taken a GI Partners Fund 4. It's a buyout fund focused on the US market, vintage 2013, 2 billion size, and invest in technology companies. Its net IRR is about 15.5%. Now, how do we go about building a peer group for this fund? And I've taken three approaches here. We built three peer groups using PitchBook data. First, we take a very loose approach. US private equity funds of 2013 vintage. So it's a very loose peer group to create for this particular fund. We have the Q1, Q2, Q3, the three quartile boundaries for that peer group. 89 funds in this sample, and quartile rank for this fund is 2. Now, if we go one step further, we make the peer group a bit tighter, so more restricted. Global PE tech funds. So here we have added a technology filter. So it's a better peer group with a slightly higher distribution of returns. 36 funds in the sample, and the rank changed to 3. Now, third case where we go extremely granular, US PE biotech funds, vintage 2013, with a size of greater than 1 billion. That's as close to the fund as possible in terms of strategy. The distribution of returns is very narrow. It goes from 15% to 10%, but also there are only 6 funds in the sample. So you've lost a lot of robustness in doing so, and your quartile rank is 1. So now the question is, to be granular, you lose robustness, and to keep robustness, that means a higher sample, you lose granularity in this manner. So which quartile rank do you believe, and what is the right answer when you are trying to assess this fund? And this is the problem that comes back again and again and again when you're trying to do peer group benchmarking. A similar concept, but I wanted to show you in a more statistical manner here. Let's say we are trying to assess a peer group performance of a 2018 vintage global buyout fund. So it's not too granular. So it's big enough strategy, broad enough strategy, and we are comparing against a sample of 200 funds that we have got. To give it a fair shot, we combine 2017 and 18 vintages. And in this chart, the bottom distribution is for the original set of 37 funds. We get the first quartile boundary of 1.18x, median of 1.38x, and third quartile boundary of 1.59x. Now, just to demonstrate the point, we draw a random sample from this set. First, we draw 90% of the random distribution, random funds from this sample, then 70%, then 50%, and so on. The point is, if you draw 90% of the distribution, 33 funds, your distribution looks quite different. Your lower and upper quartile boundaries have come down, even though your median is still the same. When you draw 50% of the distribution, 19 funds, your median is quite high. And when you draw fewer distribution, fewer sample, and then again, it reduces further and so on. The point is, it depends a lot on how you have created your peer group. How many observations are there in the peer group? How you have chosen those funds in the peer group that your quartile rank could be anything. In practice, if you were to do it with a lot of robustness, you will need hundreds of funds, which is not possible for any particular strategy. There is not enough data and it's difficult to get that data. And that's what makes it difficult to say objectively that whether that fund is performing well or not without comparing against a market. And that is our second point in this webinar. How do you compare against a market and why the choice of benchmark is important? So here, to do this exercise, we use the direct alpha method. We believe that it's one of the better approaches in PME because it expresses private fund performance as an annualized excess return over the benchmark. So it can be directly compared against the IRR. And it also, in doing so, it also takes into account the timing of the cash flows and aligns the comparison between a private equity fund and a benchmark. So very relevant in that sense. In terms of adjustment, it's really simple. You take the cash flows that go in the fund and you apply them, those same cash flows, onto the benchmark, as if you are buying and selling the benchmark using those cash flows. So a simple concept, but very interesting in analyzing how alpha we generate. So the first thing is we try direct alpha approach against a public market index. That's how typically this approach is used in the market, and it's called PME. Here we applied against the Russell 2000 index and the same distribution of funds that we had earlier. We find that mean alpha is about 10%, median is about 11.5%. It's quite high, I mean, to be fair. And about 76% of the buyout funds exhibit positive public market equivalent direct alpha. So, I mean, looking at this analysis, we can say that, there is value for investing in private markets in these funds because they are generating alpha. But is it really the right benchmark? That's the question to be comparing alpha against. And that's what we are putting into question. So to analyze this, in this chart, we looked at the sector exposure of Russell 2000 index and the sector exposure of Cambridge Associates US Private Equity Index, the gig sector comparison. And we can see that they are quite different. So that's to say that the private market has different sector and risk exposures as compared to public markets. They are not the same. So when we are calculating alpha, we have to be very careful here. The public market index is not capturing the market risk of private equities. So that's not really alpha that we saw in the previous slide. This type of exercise, PME against a public market index, this is fine if you're trying to form an allocation decision or make a view on allocation, whether investing in private markets was beneficial as opposed to investing in public markets. And this exercise is helpful for that question. But it is not really a benchmark that allows you to assess risk of any private market fund in the market or capture alpha that the fund may have generated. And that's the point we want to highlight even more, that picking the benchmark is important in this direct alpha exercise. And that's what we set out to do. We call it private market equivalent. We apply this direct alpha approach using privateMetrics indices. These indices, they represent private markets at the asset level, and they give a private market equivalent as a result. For global buyout funds, we use the Private 2000 index, And for global infrastructure funds, we use the Infra 300 index. This is a brief overview of Private 2000 index. In the charts, you have its sector exposure and its geography exposure. You can see it's well diversified across the sectors. And while it's more allocated in the US, it also looks at the global view of private equities. In total, there are 2,000 constituents in this index, 12 industrial superclasses represented, 30 countries, market cap of 1.9 trillion. So a well representation of the private equities market. On the infrastructure side, we use Infra 300 index. Again, you have the sector exposure compared to the wider universe that Infra 300 index tries to mirror. Total number of constituents, 300, 8 sector classes, 25 countries included, and $321 billion market cap of this index. So both indices represent private equities and infrastructure equity market, and they can be used for this exercise. Now, before we go one step further, I wanted to discuss one more point about fees. How do we take it into consideration? Because this question comes up quite often. Fees is a sensitive subject, and we recognize that. We wanted to address this point in two ways. One, we wanted to show that the cash flows that we use from funds, they are net of all fees. And these private market indices, they are asset level, so they are gross of fees. And remember, direct alpha approach takes those same cash flows and buys and sells that index. So if the cash flows are net of fees, the direct alpha that we calculate with this approach is also net of fees. So keep this in mind, and I'll come back to this point again, how direct alpha relates in terms of the fees and how we can think about it. But also to get an estimate of what sort of impact fees may have on the returns, we do this exercise using average fee terms of the funds in our sample. So first we look at the buyout funds that we have in our sample. We got fee terms for about 115 funds. Average fees, management fees about 1.9%. Average carry is 20% and hurdle is 8% for those funds. We saw that average net IRR of those funds was 17.5%. And if we use that as a rough approximation, we can estimate a fee impact of about 4.5% in buyout funds between gross of fees returns and net of fees returns. So it's a substantial percentage of return that is impacted by fees. Similar exercise if we do in infrastructure, we got fee terms for about 62 funds in a sample. Average fee is 1.68%, carry is 18, hurdle is 8%, which I was initially thinking is a bit high, but that's what we got from the fund terms in this data set. And with average net IRR of 8.7%, we estimate a fee impact of 2% in aggregate on infrastructure funds. So again, remember these points. In buyouts, fee can have an impact of 4.5% on the returns, and in infrastructure, fee can have an impact of 2% on the returns. I'll come back to this point and show you how it relates to alpha. Right. Now, this is the crux of the analysis. Here, we have shown you two distributions. On the left side, that's the alpha calculated with this approach, direct alpha against private 2000 index, and how much alpha does each fund in our sample generate. On aggregate, we see that there is zero alpha, very close to zero. Mean is minus 0.84, median is minus 0.7%. That means taken in aggregate, all funds together, some funds have positive alpha, some funds have negative, and they tend to offset each other. And in aggregate, there is zero alpha when we have taken a large enough sample. The second distribution is of the market return. That is, if we take the cash flows of the fund and buy and sell that index, what sort of return do we generate from that market as a whole? And average is 18.4%, median is 18.7%. That is, majority of the average IRR that we saw earlier, 17.5%, that is driven by the market return. This is a very important point that on aggregate, most of the alpha is, the average alpha is zero against this private market index. That means this index is actually the representation of the market. That's how it should be. Gross of fees, average alpha would be close to 4%. we told you that fee has an impact of about 4.5% on the returns. So if you take fees out of the equation, gross of fees alpha would be about 4% in buyouts. How does this alpha and market return compare by sectors? So you can see that on the x-axis, there are different sectors outlined, and we have the distribution of alpha and market return against that private 2000 index. Alpha is, first, if you look at the alpha distribution, it's available on average in only very few sectors. So we have professional and other services, which has an average positive alpha, information and communication and health sectors. But rest, it's mostly negative alpha that comes from sector-focused strategies, sector-focused funds. Market return is, again, the main source of return for most of the sector strategies. That point gets reinforced that even though the strategies are sector focused, they're driving majority of the return by investing in the market. The same analysis of alpha and market return we can also do by vintage years. So if you see from 2011 to 18, alpha goes up and down. So there is some volatility in alpha. And this brings out the point about vintage diversification. Most investors believe that that's the right strategy. And we prove that, that alpha can be positive or negative between from one vintage to the other. So that diversification will have benefit in sort of diversifying that exposure. And market return is, again, the main factor for returns, but it's also trending down over time. So that's another important observation, that with vintages, more recent vintages have lower market return as compared to older vintages. And that's consistent with the trend that we see in private equities as a whole. Now, on infrastructure side, we do the same analysis, but with Infra 300 index. Again, our mean alpha is very close to zero. And market return is the major driver for returns in infrastructure funds. On a gross of fees basis, average alpha would be close to 2%, because the fee impact in infrastructure we estimated to be about 2%. So if we could measure alpha on without fees, we would get about 2% alpha estimation. By sector focus, it's again the same sort of conclusion as with buyouts. Very few sectors have the potential to generate positive alpha. We see it in data infrastructure and some in social infrastructure, but most of the sector-specific funds have negative alpha on average, while there are some outliers though. So that's the important thing, that this is the average alpha, but these dots represent some funds which have been able to generate very large alpha in infrastructure. Market return, again, is the main driver for returns in infrastructure as well, as was the case with buyouts. When we compare by vintage years, and here we see that the period from 2012 to 2014, we have some positive average alpha or close to zero average alpha, but in other vintages, average alpha is negative. So those were the good years, and majority of the funds were able to generate positive alpha in those years, in those vintages. And market return, again, it's volatile over time, but remains the primary source of return. So we have established these points quite clearly, and now I'm going to summarize that. So on average, we found that alpha is zero in private asset funds when you benchmark them against a private index. And this is normal behavior. A market index represents the average performance, and half of the population should be above and below. So this makes sense. Conversely, it also shows that this is the right index, because this index represents the market, and only then on average you could have zero alpha. Market performance or market risk is the main driver of fund performance. And this is a very important point. So if you're investing in private assets, you might be focused on alpha, but majority of the funds generate return through market risk by loading onto the market risk. So in order to measure this risk, you need to have an index so that you can benchmark the performance of a fund against the market. And that's what reestablished the importance of proper benchmarking exercise in private markets, so that you can measure how much risk each fund is taking in order to generate that return. And Finally, the good point is that about half the fund managers do actually generate alpha, and we'll look at this ranking as well later on in this webinar. But before we do that, I want to take a few minutes to talk about sources of alpha, how we split this alpha into multiple sources. So we believe that asset owners or managers generate alpha in three ways: asset allocation, by making some strategic bets on different segments of the market; by selection of investments and when to make distributions and contributions; by structuring, so adding or reducing market risk as they start to invest and invest the funds. For each fund in our sample, we can also observe a stated strategy by the fund. What sort of sector it focuses on, what geography it focuses on, and that corresponds to the long-term allocation choices of that fund. Therefore, we split the total alpha of each fund into two parts. One, the alpha that is generated by these strategic bets by choosing to have higher or lower exposure in certain sectors and geographies. And two, the pure alpha, that is basically the investment selection or timing decisions of a manager. So in terms of a simple equation, we say that fund IRR is roughly can be split into three components: market return, alpha due to allocation source, and alpha due to pure selection of investments. For funds where we have a specific geography and sector focus, we build a custom benchmark by matching their geography and sectors. And we can do this because we have the very granular benchmarks in privateMetrics, which allow us to build this custom benchmark for each fund. And once we have done that, we can calculate direct alpha against the custom benchmark. So benchmark focuses the same strategy and the fund focuses the same strategy. So the alpha that you get by this exercise, this only captures the investment selection and structuring decisions, right? So the timing of the cash flows, because asset allocation is now controlled in this benchmark. This is what we call pure alpha. And allocation alpha is basically the difference of total alpha that we get against the whole asset class, and pure alpha that we get against this custom benchmark. So simple concept, and we have tried to isolate these sources of alpha in this way. How does it look? In buyouts, we get an average asset allocation alpha of about 4%, 4.6%. And pure alpha, that is due to investment selection and timing, is actually negative, about 5%, minus 5%, both mean and median. That means picking the good investments and timing the cash flows, it's a much harder thing to generate return with rather than asset allocation. So following the trend and picking the good sectors or geographies, that's relatively the source or the majority source of return. And in this pure alpha, we also note that 4.5% that buyout fee impact is also a reason why part of this alpha is negative. And the pure alpha is negative for buyout funds. If we compare this allocation and pure alpha by sectors, here we find again the same conclusion that allocation alpha is the major source of alpha in buyouts. There are some sectors like real estate where allocation alpha is very high. That is, it's easier to generate return by following certain trends in real estate and construction. But on the other hand, the pure alpha in real estate and construction is very low and negative. That is, picking good deals in that sector is even more difficult as a result. So interesting conclusions by sector. Similarly, if you look at by vintage, we established the same pattern. Asset allocation drives majority of the returns on average. And pure alpha, that is picking the investments and timing, is on average negative, even though it's volatile between vintages. So again, the point on diversification becomes relevant. Same exercise we do on infrastructure. Asset allocation alpha is close to the same number, 4.5 to 5%, and pure alpha is minus 4% to minus 6% median. And almost half of this negative alpha is due to fees. So the point that I said earlier, that picking investments is actually even more difficult. Good deals is even more difficult in infrastructure because this average pure alpha is much more negative in comparison. By sector focus, we see that asset allocation again drives majority of the alpha, but especially in certain sectors like utilities and social infrastructure, the funds which focused on these two strategies, they actually had negative alpha by overloading on these two sectors. On the pure alpha basis, on average, it's very low across sectors, but there are opportunities and there are outliers where funds can generate quite high pure alpha by selecting really good deals at times. Similar behavior by vintage year. Allocation alpha goes up and down by vintages, so diversification becomes important. But the important thing is pure alpha in infrastructure remains negative almost for all vintage years in average, on average. So while individual funds could generate pure alpha, on average, it's very difficult for infrastructure fund managers to generate alpha by picking good deals or timing the cash flows. So, which brings me to important findings of the sources of returns section. First, most private fund returns come from the private asset return market as a whole. And that we can see in this chart. We have combined all 228 funds together, and market return is the most important source of return across all the funds. Second, allocation actually can generate alpha. So it's in line with the literature that we know about asset allocation. By following certain trends or by overloading on certain strategies, we can see that there will be benefits of generating alpha. And finally, pure alpha is the most difficult to generate. On average, it remains negative, but it also presents the most dispersion in alpha. So there are some funds which are able to generate very high alpha and others which generate negative alpha, very low negative alpha. Second important finding is if we look at certain hot sectors, here I've taken the example of tech sector. When a sector is hot and growing, almost all the return, so allocation alpha is close to zero, pure alpha is not too high, most of the return of tech funds is generated by market return because the whole sector is growing and it's hot right now. So that takes priority. But there are still opportunities. If you see again pure alpha, there is very wide dispersion. So there are still opportunities to pick these good deals and generate alpha within that sector as well. So some concluding remarks before I move on to ranking. First, unlike a peer group, a market index aggregates all the information that is relevant to assess risk and performance of a fund and of the market. Using an index like that, we can make it possible to discriminate between funds, that which are the funds that actually beat the market and generate alpha, and which funds do not. It's also possible to assess the value that a fund manager creates. So we can assess how much of the return a fund manager has generated by taking on the market risk versus adding value through generating alpha in that fund. And using a strategy-specific benchmark, I showed you that we can build a custom benchmark by following sector and geography of a fund. We can isolate these two effects and compare them, that how much of that alpha is actually generated through skill versus allocation decisions of the manager. And finally, using a private market index, we know that not everybody is in best class. We showed you just now, but it's also clear that who is the best and why. And that's about ranking. And finally, before I just take a second here, it's easy to do with Informatics API. So we have built this use case in the form of an Excel document, Excel file, and a Word document, which describes how you can use the API. But basically, all you need is to input funds, cash flows, and NAV, define the fund strategy, use the Informatics API to select the appropriate benchmark for that fund, and then direct alpha gets calculated within that Excel template. So it's really straightforward to do. And I encourage you to use this QR code to download this template. Right. Now we come to the ranking part. I've got 10 minutes left, and this is arguably the most interesting result I wanted to show today. Which are the top funds and managers, and how do we go about finding them? So to do this exercise, we have expanded our database. We have not only looked at fully invested funds, but we have expanded to all the vintages from 2003 to 2023. In total, we have about 312 infrastructure equity funds Methodology used is the same as before. We calculated total alpha against the Infra 300 index to isolate the return of a fund after taking risk into account. So we have taken into account market risk by loading onto that index, and whatever return we generate, that's alpha, as I explained earlier. And we calculate three types of rankings. First, fund ranking, which identifies the largest alpha fund in each vintage year and who is the manager. And this is, I'm going to show you just the top fund, but basically we have ranked each fund out of these 312. So we can separate or create views however we like. We can split them by strategy. We can split them by vintage. We can see top 5 funds, top 10 funds in each vintage and whatever. And we will publish more of these reports soon. Manager ranking. Here we look at managers which have more than 3 funds in their entire track record so that it's of meaning, and the one fund was not just a fluke that they could generate high alpha. So to keep that consistent, we look at only managers which have more than 3 funds, and we look at the median alpha of those funds and rank them based on that. Finally, we look at alpha persistence. Managers with the highest proportion of alpha, managers with the highest proportion of alpha generating funds, that out of their total track record of funds, how many of them have generated positive alpha over time? What percentage? These rankings enable a fair comparison of funds. So LPs can basically use these rankings to select the best fund, best managers, compare their historical track record, and endless use cases. It can be used to monitor a fund's performance over time and so on. And GPs can use these type of rankings to demonstrate their superior skill set. This is a very competitive environment. We know that fundraising is difficult, and this allows GPs to set themselves apart by following these rankings. So first, top infra equity funds by vintage. So here we have looked at the last 10-year vintages, excluding 2024, because it's quite recent and there are hardly any investments in those funds. And we calculated alpha for each fund in that vintage. And these are the funds which rank the highest by alpha in each vintage year. And who are the managers who manage these funds? The important thing is that while you could have same manager like Brookfield Asset Management here, their Brookfield Infrastructure Fund 3 was the highest alpha in 2016 and also in 2021, Brookfield Global Transition Fund. But that doesn't mean that the same manager comes up repeatedly in this exercise. So that's one interesting observation I had, that there's different manager funds that come up as the largest alpha. There's less persistence in that sense. That same manager keeps delivering higher alpha every vintage year. And also that's because if they are in a series of funds, it comes out every 3-4 years. So that's also partly the reason behind this observation. Next, we look at top infra equity fund managers. And here we have looked at, like I said, median alpha. We are showing you the table of managers in the descending order of alpha. So the Aberdeen manager, they have 3 funds in our sample in their track record, and they have the highest average alpha. Brookfield is next, Energy Spectrum Capital is third, and so on. We can see there are some popular names here, Carlyle, BlackRock, GIP, and so on, which have a lot more funds in the sample as well. BlackRock has 11 funds, and their average alpha is still able to rank them in the top 10 managers by this exercise. And the last bit of exercise is persistence of alpha. So how many or what proportion of their historical funds have generated positive alpha? And that's arguably the most important thing, right? That if you're trying to use it as a predictive analysis, you also want to consider how many of those funds, it's not that 1 or 2 funds were able to generate high alpha, but what sort of persistence is there in generating alpha. And we find that there are some funds like Aberdeen's, all 3 funds, they have had positive alpha. 5 Point Energy, they have 3 funds and they've all generated positive alpha. Whereas not the same thing for Brookfield's 7 funds, which have 86% persistence, and so on. So while majority of the list from the top managers also is here, but their order has changed and there are some new names in there as well. So This exercise is obviously important for LPs who are trying to assess managers. But as I said, managers can also use this to demonstrate their superior skill set. And together, if you think about it, the three things, finding the top fund or ranking the fund in each vintage or strategy, the ranking of managers and persistence, together, these three exercises can help you identify these top managers and understand which manager is actually delivering alpha on a regular basis. We will publish a more detailed report about this, and stay tuned for that. And that brings me to the end of the webinar. I hope you enjoyed it. There are some questions I think that I want to take. What is the impact of the investment style, core versus opportunistic? That's an interesting question. It's from Thomas. I actually wanted to look at that, but the thing is, the data set that we were using from Preqin, it is not always so consistent with that strategy, core, value added, core plus, opportunistic, and so on. So we base the custom benchmarks based on sectors instead, if there was a sector focus. And that partly covers the investment style, but definitely we know that core funds have much lower IRR. They are closer to the market. So I expect much lower alpha for core if we could isolate those strategies as well. There is a question from Aziz. How do the private market indices compare with public market indices? Is there illiquidity premium or any other premium? Right. So private market indices, they are asset level and they only reflect the performance of private market assets. So we don't add any liquidity premium on top of public market as such, but the way we construct the indices is to look at the transactions that happen in the private market, and the index constituents are also from the same private market. So we don't mix and match public and market in that sense. And yeah, that's why they truly reflect the point that I was making. They truly reflect the risk of private markets and allows us to capture alpha for each fund. There is a question from Jared. Are the private markets benchmark transparent? Meaning, can the users of the benchmark know the components and weightings of the benchmark? Yes, definitely. So users of the benchmark, we give the full list of constituents with their classification by sector, geography, and so on, and the weights in the benchmark as well. So very transparent in that sense. The whole purpose is to make these benchmarks as transparent so that this type of exercise can be conducted on a self-serve basis for any institution investor trying to assess funds or calculate alpha or generate or compare managers. And finally, there's a question from Alex. In your calculations, how do you account for J-curve effect in the more recent vintages? How many years should a vintage have in order to be relevant to performance measurement? Right. I think there are two parts to it, Alex. So that's one reason why I was trying to look at the long-term performance or long-term alpha initially on a distribution basis. I kept only the funds until 2018 vintage so that these funds in the J curve, they don't dilute the alpha effect. And we actually look at the alpha of the market based on the funds that are fully invested. So that's why the first section of the analysis was only until vintage 2018. But in the ranking part, we did actually include all the recent vintages as well. And there is a J-curve effect. So our argument is that if you're using cash flows to calculate alpha, the higher the J-curve, the bigger the J-curve. That is, if a fund takes longer, let's say, to invest the funds, there will be a much bigger J-curve effect, and there would be a much higher negative alpha. So it is possible that majority of the funds in recent vintages have negative alpha, but when you are trying to assess them on a relative basis, your comparison is still fair because you have used market index to compute their performance, right? So even though, let's say, one fund had minus 3% alpha and another had minus 6, you can still argue that the fund with minus 3% alpha is able to deliver better performance, given that it's a recent vintage and still in J curve. It's still a better performing fund against the market, private market. And finally, there is a question from David Hakami. When you say allocation alpha becomes market-based, take example, do you think about when the entire market is hot, some sectors may display high beta to general market? And so in some sense, selection is actually similar to leveraging up the broad index. And would you still consider that skill? Um, there is a correlation for sure, because we know tech sector has been uh, the driver for the whole market as well. So there is a correlation between the two, but I'm not sure if it's still classified as selection, and that can be up to perception as well. But selection is usually about picking the investments within the sector. If you are able to just generate or just invest in the tech sector, and the whole tech sector is supposed to have higher valuations and generate better returns, then that's not really down to the skill set. But maybe others in the group have a different opinion. But I wouldn't still consider that as a skill of a manager, to be fair. Joseph, okay, good. Jumping off Thomas' comment, how can we accurately capture alpha for a given fund when the benchmark universe contains a combination of value and opportunistic strategies? A value fund might always look weak if the benchmark is skewed opportunistic, since it is not an apples to apple comparison. Yes, I mean, but it's not a benchmark, a strategy benchmark for that opportunistic fund. That's the second component that we had in our exercise. We have a market benchmark that represents private equities market as a whole, and that combines core, value added, core plus, everything, because that's the infrastructure market. But what you're talking about here is the second component, the way we generate pure alpha. And here we actually used sector-specific benchmarks. So while we didn't have access to the strategy of individual funds, we used their sector focus to build these custom benchmarks. And in doing so, the pure alpha that the fund will generate against that benchmark will be corresponding to whether you are investing in data infrastructure or in social infrastructure. One would be core and other might be core plus or value added, because it's a riskier sector to invest in. So partly that comparison is in that strategy benchmark for that fund. Okay, there are no more questions. If there are still any questions, I'll be happy to take them offline. You can contact us at this email address. If you have any questions about the products, you can still contact us at this email address, and we'll be happy to answer those queries. Thank you very much, and I hope you enjoyed the webinar. Thank you.